This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Sunday, July 5, 2026, and this is the After Hours session. Now, let's get into it. Extreme fear at 14. That is the headline going into the weekend. The Fear and Greed Index has collapsed to single digits, signaling a market in freefall. Yet, look closer at the macro data. The National Financial Conditions Index is deeply loose, credit spreads are at historic lows, and the yield curve is normalizing. We have a massive divergence between structural liquidity and market psychology. Is this a capitulation bottom, or are we walking into a liquidity trap? This is ShadowQuant, and this is the week ahead. Let's set the stage. We are coming off a Friday where Bitcoin settled at $63,628, holding a modest 0.8% gain, but the broader picture is grim. Ethereum is struggling at $1,787, and altcoins like XRP and Cardano are bleeding. The total crypto market cap is hovering around $2.28 trillion. The VIX closed at 15.81 as of last Friday. A relatively calm backdrop for equities, but inside crypto, the volatility is spiking. Solana is showing annualized volatility of 56%, and VaR metrics suggest potential daily drops of nearly 10% for smaller caps. We are in a regime where extreme fear is the default, and historically, fear like this persists. The question for this week is not if the pain continues, but where the floor actually is. I'm looking at the sentiment data, and frankly, it is ugly. The Fear and Greed Index is at 14. That is extreme fear. The 7-day trend was rising at 12, but we have snapped back down hard. When you see sentiment this low, it usually means retail has capitulated. But here is the nuance. The macro regime analysis explicitly flags contrarian bullish because the NFCI is at 0.504. That is very loose financial conditions. So we have loose money, but terrified participants. The divergence is the story. Consumer sentiment has plummeted to 44.8, which is in the 0.2 percentile. That is a historic breakdown in confidence. Usually when consumer sentiment hits that low, it's a lagging indicator that a bottom is near. However, the z-score of 0.98 on the fear index means we are nearly a full standard deviation below the mean. My read: the crowd is too bearish. But too bearish doesn't mean buy yet. It means the potential for a short squeeze is high if any positive catalyst hits. My call: Bitcoin neutral, target $63,628 by Friday. I'm not calling for a rally until sentiment ticks above 25, which is a slow grind. We are stuck in the mud.
Let's look at the charts because Pulse is talking about psychology, but I'm talking about price action. Bitcoin is sitting at $63,628. The recent daily history shows we are testing critical support. The technical structure is fragile. On Bitcoin, we saw a shooting star on July 4th followed by an advance block. That is a classic reversal signal, confirming weakening momentum at the top. For Ethereum, it's worse. We have an advance block and a Dodge star pattern on July 4th. Both are bearish. The Dragonfly Doji suggests some bid support, but the overall structure is breaking down. The 3 inside pattern on Triple Q and SPY on July 2nd was bearish, suggesting the broader tech market is also turning. I'm seeing a closing Marubozu on SPY from June 30th that was bullish, but that was days ago. Now we have conflicting signals everywhere. The Hickek on Triple Q is bullish, but the 3 inside is bearish. This indecision is dangerous. My read is that we are in a consolidation zone with a downward bias. If $63,600 breaks on high volume, we see a flush. If it holds, we range. I'm not seeing a breakout setup. My call: Ethereum bearish, target $1,750 by Friday. We need to break below $1,780 to confirm the breakdown. Until then, this is a dead cat bounce at best.
I'm looking at the flows, and this is where it gets interesting. The spot market is fearful, but the derivatives market is overheated. Let's talk about funding rates. Bitcoin funding is at 5.4E05, which is in the 79th percentile. That means longs are paying shorts to hold positions. It's expensive to be long. Ethereum is even worse. 5.9E05, 73rd percentile, and the 7-day average is much lower, meaning this leverage just spiked recently. But But the real story is XRP. XRP funding is at 0.0001, which is the 100th percentile. It is higher than any point in recorded history, and the 7-day average was negative, meaning we flipped from short paying to long paying overnight. This is a massive contrarian red flag. It suggests that despite the extreme fear on the spot market, leveraged traders are piling into XRP longs, likely betting on a legal or regulatory catalyst that hasn't happened yet. On-chain, we see commercial hedgers in traditional markets, gold, oil, currencies, are at the 100th percentile long. That is smart money accumulation. But in crypto, we see overheated longs on meme coins and altcoins. Dogecoin funding is also elevated. This disconnect suggests that the smart money is hedging risk, while the dumb money is leveraging up on speculation. My call, XRP neutral, target $1.15 by Friday. The funding rate is unsustainable. If the spot market doesn't follow through, these longs get liquidated. I'm waiting for the funding rate to cool down before I see a clean setup.
I'm here to stress test the bullish case because everyone is whispering buy the dip because the fear and greed index is 14. But let's look at the risks nobody is talking about. The macro data says risk on, but the credit markets are showing a contradiction. High-yield spreads are at the 2nd percentile, which is tight. But look at the TED spread, it's 0.9 at the 1/3 percentile. That is near zero interbank lending spread. It sounds good, but it also means there is no fear premium in the banking system. If a shock hits, there is no cushion. More importantly, look at the options market for crypto-adjacent equities. MARA has an Roman 4 rank of 99.7. HOOD is at 100. TSLA is at 99.8. These are not just high volatilities, they are maxed out. When implied volatility is at 100%, it means the market is pricing in a massive move. But who is selling these options? Usually, it's market makers hedging against a crash. Furthermore, insider selling is heavy. The buy/sell ratio is 0.00x over the last 30 days. That is zero buying. Insiders are exiting. An MSTR MicroStrategy has bearish news sentiment despite Bitcoin being bullish. This suggests that even the biggest Bitcoin holders are skeptical about the leverage play. The biggest risk is a volatility trap. We have extreme fear in spot but extreme leverage in derivatives. If Bitcoin slips below $63,000, those overheated longs on Ethereum and XRP will get liquidated. The liquidation cascade will drive prices down, triggering more stops. My call. Solana bearish, target $78 by Friday. Solana has negative funding, which looks safe, but it has the highest VaR in the dataset. A 99% CVaR of -12% means if the market turns, Solana gets crushed harder than Bitcoin. I'm shorting the volatility here.
Let's tie this together. We have a market in extreme fear, 14/100, but the macro regime is strong risk-on with loose financial conditions. This is a classic divergence. Usually when macro supports risk assets but sentiment is this low, a bounce is likely. However, the technicals are not confirming it yet. Bitcoin is showing shooting stars, Ethereum is breaking structure, and funding rates are overheated on altcoins. The smart money in traditional markets, gold, oil, currencies, is long, but crypto insiders are selling. The options market is pricing in a massive move, likely to the downside, given the extreme Roman 4 in HOOD and MARA. The risk is that this extreme fear is a result of leverage unwinding, not fundamental value destruction. My view is neutral to bearish for the short term. We need to see funding rates normalize and for Bitcoin to reclaim $64,500 with volume before I consider a bullish entry. Until then, the path of least resistance is down or sideways. The contrary unbullish signal from the macro data is a long-term play, not a weekly one. My call, Bitcoin neutral, target $63,000 by Friday. We test the lows, flush the leverage, and then stabilize. I'm not chasing this rally until the structure is clean.
So we have grid calling for breakdown in Ethereum, CIPHER warning of a liquidation cascade in XRP, SPECTER shorting the high volatility Solana, and Pulse and Apex staying neutral, waiting for sentiment to shift. The consensus is caution. With extreme fear at 14, the market is primed for a volatile week. Will the macro tailwinds save us, or will the leverage unwind take us lower? If you're finding value in this analysis, support the project at patreon.com/ShadowQuant. Patrons get early access to every episode, weekly AI analyst scorecards, and daily intelligence briefs. And if you're listening on Spotify, Apple Podcasts, or YouTube, hit that follow button and leave a rating. It helps more traders discover the show. We appreciate you. This content is generated by artificial intelligence and is for informational and entertainment purposes only. It does not constitute financial advice. Crypto markets are highly volatile. Always do your own research before making any investment decisions. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.